This is the London Fintech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is London Fintech Podcast, episode 91, brought to you in association with Blue Motor Finance and Smart Pension. I'm delighted to be joined today by Oliver Schimek, CEO of CrossLend. CrossLend have a nice simple strapline, connecting the world's investment capital with the real economy's financing needs through single loan securitization. As single loan securitization is a subset of securitization, we'll focus the core of this episode on that. We all know roughly what securitization is and how it works, and it's been a huge deal in the US and a rather smaller deal in Europe. However, unless you've worked in that industry, that's probably as far as your knowledge goes, other than perhaps that securitization has also been a metaphor, and here I'm talking about a 30-year plus timescale, not just the latest crisis, a metaphor for investment bankers taking plenty of value out of a package, filling their boots, and slicing and dicing the remaining, far poorer value in ways that bamboozle investors, and perhaps all too often bamboozle the rating agencies. Anyway, like all areas of finance, nothing is remaining untouched by the digital age and the fintech revolution. Go back 30 years and the idea of securitizing a single loan could be done. After all, that's where the Eurobond markets came from. However, for the sake of argument, it could be done at quite a price and perhaps only over $100 million or so ago. The likes of CrossLend leverage technology in order to be able to promise to do this far cheaper, or perhaps I should say far, far cheaper, or perhaps I should explicitly say about 200,000 times cheaper, for deals roughly 100,000 times smaller. Isn't that amazing? So let's make it one of these shows where my intro doesn't last a week and just dive into securitization in the fintech age. Plenty to talk about, so let's get on with the show. Hi Oliver, thanks for joining me today.
Pleasure, Mike.
So you've flown in this morning to Mayfair, where we are now, from Berlin. Actually, I should ask you what the weather's like in Berlin. I haven't done my usual English thing about talking about the weather yet. I got a slight hangover as a result of excess research last night on a board project that I'm doing. It wasn't actually the research that gave me the hangover, of course. It was the wine that went with it. Anyway, you were saying that you flew in on an aeroplane, as people tend to fly, but that in the dim and distant past, you had ideas about having different seats on aeroplanes.
Well, yeah, that's some time ago.
You mean when you were 5? Or
Yes. No, but honestly, actually, I wanted to become an airline pilot originally, and passed all the exams, and then September 11 happened, and that was it with airline pilot's dream. Yeah, so then moved on and studied physics instead.
Ah, interesting. So do you have a pilot's license then for doing small planes and things?
No, but I'm actually, I should find the time for that. But so that's quite a time-consuming hobby, because you should have a proper number of hours, otherwise you lose it again. But that's indeed something that's on my list.
Yes, and I mean, maybe a suggestion is, as I was saying at the beginning, going impressively cheaper than current securitization, 200,000 times or whatever crazy number it was. Maybe if I can make a suggestion that you just make yourself 200 times cheaper, then you'll be able to buy your aeroplane a bit faster. But we'll come on to the CrossLend business model in a minute. So from doing all the exams about being a pilot through to doing physics, what was your journey along the way to get from there to here?
Well, actually, I finished my physics studies with focus on nano and quantum mechanics. Then basically ended up doing what I used to do all the time during my studies, and made it my hobby profession, and started my first startup developing foreign exchange quant trading systems. I did that together with 2 colleagues from university. We raised some money and built a quantitative trading solution for ourselves at the first bank using that. And then, however, one of my 2 co-founders died in very young ages, so I had to quit that and looked out what else I could do with the knowledge I had built there, and found a startup, which you probably know, it's CreditTech. Joined CreditTech very early in 2012, because I just called them and said, okay, look, I don't know how I fit in, but I should fit in somehow. I was thinking about some position in the risk department. But then I got offered the position of the CFO That didn't exactly make sense because I had no corporate finance background, but in the end, numbers is numbers. So I started an incredibly interesting adventure at Creditech, developing together with Sebastian and Alex scoring technology out of thin air, and basically started to build a very interesting business together with these two amazing entrepreneurs. I stayed at Creditech for about 2 years and then had the idea for CrossLend, which was basically in the beginning to overcome the cross-border gap for peer-to-peer lending.
Yes, I think you were saying to me before that you had ideas of single markets in Europe, and I was recalling my fund management days ahead of 1992. European equity markets were performing extremely well because in 1992 there was going to be a single market in Europe. Now that's very nice, makes things very simple. And 25 years later, we're still slightly waiting for that.
Well, we're fighting with it every day. But it's also, of course, the opportunity that we have here because the markets in Europe are extremely fragmented, especially when it comes to lending. Especially peer-to-peer lending back then was only happening on a domestic level, so no cross-border lending was really happening on a significant scale due to multiple problems when it comes to cross-border funding or even the risk assessment in different countries. It can be very versatile. So what we did was creating a setup to overcome that problem, and this was where we then first got in touch with securitization, because that was actually one of the challenges to make assets transferable between the countries and in a way that investors would understand in another country.
An interesting example of a pivot insofar as you set out on a journey and you realise that in order to make that journey you needed a certain kind of vehicle, and then over time you realise that actually you're not the only person who could use that vehicle, and maybe the vehicle is really interesting and useful itself.
That's exactly how it was.
I say vehicle actually because it's a very painful thing as you're coming from Germany, but Berlin is a long way from Munich. I made the mistake, I'm not going to do this again, I made the mistake a little while ago of ordering a new motor car from Munich, as my old motor car from Munich is sort of 20 years old, has sort of died a little bit.
Why was it a mistake?
Well, it was a mistake because I kind of spend too much time in this digital age and, all this stuff about being consumer-focused and all that kind of stuff. So, Bayerischer Motorwerken in their infinite producer-centric model, if, like me, you go along and you buy a new one, I got an incredibly good deal, actually. I think new cars are selling slowly in Europe or something, so it's like £10,000 off or something crazy. So, you go along and you place your order, and then basically the factory sits on it for 2 months. Literally. I mean, I think maybe more than 2 months by now. And then I heard they made it on Monday. I just can't get my head around it. I'm actually interested, if any listeners know the answer to this, please do email me or ping me on LinkedIn. I'm interested in this phenomenon because it literally takes a day. Actually, I think it takes a day and a half, including letting the paint dry, to build a BMW from an order which you put into your dealer puts into a computer and it goes over there. So, in principle, there's no reason that you couldn't, order a BMW today. Well, if you're in Munich, say, so it doesn't have to be transported around Europe, and have it by the weekend. Now, wouldn't that be a phenomenal service? Talking about impulse buying, which Amazon has done a really good thing. I've pressed the button, you buy it. My house is full of books because I keep pressing the button, which is easier to do than read the books, actually. But they don't do that. As I say, they sit around for 2 months with the order.
Well, I guess they're afraid that for a couple of days nobody's ordering one.
I don't know why. Maybe it's EU quotas or something like that. Anyway, there's a complete, utter tangent. And as you're from Berlin, I can't blame you for the wrongs going on in Munich. Although I need to be nice to them because it's still on the way to Zeebrugge. So you came up with this vehicle. We'll come back to the particular way that you're doing it in a minute when you've informed the audience a bit more generally about securitization, because I think if they understand that, then they'll start to understand how remarkable the vehicle was that you created in terms of the fact that it's like hundreds of thousands of times, just say better for the sake of argument. So maybe we'll just go into securitization a little bit. I suspect securitization has in one way or shape or form been around for centuries, but it's certainly been around, as I say, if you want to call it the Eurobond market securitization, I guess one can. It's a definitional thing since the 60s, but particularly 80s, 90s, noughties and onwards, and I think the advent of computers helped that. So just want to give us a little background, and for those listeners who haven't been involved, how it kind of worked in, let's call it the old world, in a pre-fintech world, and still continues to work in the investment banks.
So good news is I'm not one of the persons who has seen that. So I basically can only tell what I know from reading about it and hearing from other people about it. But essentially, of course, it didn't change. We just decrypted, so to speak. Well, the basic idea is very simple. You have a special purpose vehicle, and you put some debt into that. You buy debt with that, and you refinance that debt by issuing a paper with security, which makes it then, in the end, transferable.
And by special purpose vehicle, just to keep it sort of simple, we basically mean that, let's say we're going to securitize something. let's say we're going to securitise the furniture in this room, then what we would do, schematically anyway, is we would set up a UK company for the sake of argument tomorrow. We would transfer the value of all the furniture to that UK company. That company wouldn't do anything other than, keeping it simple, hold the furniture. At which point we then, for the sake of argument, issue 10 shares. So people can own 1/10 the furniture.
Yes, and the furniture is actually a good example, because if you want to own that furniture, at least the economic cash flow impact or whatever of that furniture, but you don't want to move it, so securitization is exactly the way to go. You have the furniture at one space that doesn't move, and you have a paper that you can move and that represents the economic value of it.
Yes, okay, so the basic element is fairly simple. We'll come on to the pricing in a minute. So there are two categories of people. Let's leave aside the investment banks who clearly benefit from doing it because they charge a fortune. But there are two categories here. There are benefits for originators, those people who create loans, and they want to get them off their balance sheet for some reason. On the other hand, the mirror image of that, on the other side of the balance sheet, is investors who might want to own 1/10 of the furniture in this room, or 1/1,000,000% of a whole bunch of mortgages and get the cash flows from that. So how do the benefits work for originators and investors?
Yeah, sure. I mean, basically the originator is the one that deals with the customer, right? But that's not necessarily the one that wants to be exposed to all the risk. So there's a good reason why, to a certain extent, need to split customer relationship and risk. And this is something that you can do with securitization. And basically the originator could be in a position where he could originate more loans, but he doesn't have the balance sheet capacity to invest into these loans, not at 100%. So this is a typical problem of an originator. That's called then balance sheet relief. If he sells parts of his balance sheet. The typical situation is originators that have an overcapacity, so they have more customers and more demand for loans that they actually can fund. And on the investor side, it's the opposite situation. You can imagine an insurance company or a pension fund, for example. They don't have any branches, nor do they have any exposure to retail customers, for example, but they need to invest into something because they need to do something with the money that they're trying to manage for your pension or whatever. So they need assets to invest into. So there's a natural synergy if you create a bridge between the two.
Yes, and so in terms of the originators, going back to my weak analogies today, in a sense, for the originators, if they're using up all their production capacity at the moment, as clearly BMW are, but if they suddenly get the ability to produce more cars, then they'll be able to do more business and make more money. And as you say, the strength is actually doing the loans and all that kind of stuff. And in BMW's case, they'd have to kind of borrow factories somehow. It's not clear how you can do it. But in finance, however, as you say, you just take all the loans they've done, you ship them off to somewhere else.
Yes.
They, as it were, get some money back, and then they can lend that money they've got back to a next round of people.
Exactly.
Putting it simplistically. And it's often said there isn't much money in the world, but there's actually huge amounts of capital just sitting around waiting to be invested.
Yeah.
And if it's done attractively, then the investors have got a nice asset. So that sounds nice and simple. So what are the problems then of securitization? Or challenges?
Yeah, the challenges. Well, if you package stuff into something and create a paper out of that, there is some natural knowledge asymmetry and information asymmetry in that thing. So basically, the investor needs to somehow trust, somehow rely on, and somehow do his own checks what's in that package that he's buying. Of course, there is then third parties earning a lot of money by trying to assess the risk. That's the rating agency, so they're then telling the investor what's inside that package. But of course, there's still the possibility that whatever's in there, due to the intransparent nature of the papers and also due to the degree of complexity of such transactions, it's just not visible to the investor and sometimes neither to the rating agency. So that's a typical risk for the investor. Problem for the originator is actually costs. So the costs of these transactions can be really significant.
So for example,
costs that are involved with that is the warehousing costs. I mean, if you want to securitize a 500 million euro package of loans, then you first need to build it. So you need balance sheet capacity to build that package. And then there's a bunch of lawyers earning a lot of money. There's a bunch of structuring agents that earning money. So these transactions only make sense if they have a certain size.
So what kind of costs are we talking about? We're talking hundreds of thousands?
We're talking about millions for typical transactions. If you include everything, setting up SPVs, warehousing costs, structuring costs and rating costs and so on. So that means that if you want to do such a deal, then of course your portfolio, depending also on the asset class, needs to have a certain size. So typically you would not start below 100 million to do a securitization, rather 200, 300 million, and if it's other assets then it's even more. So depending on the yield and the duration and everything. So these are problems for originators, because if you need that size in the portfolio, then this is something that excludes smaller institutions, because imagine you're a bank that has a balance sheet of $1 billion and you want to do a 500 million deal. That's 50% of your balance sheet. So that means that you have a very nasty gap in the usage of your equity at the day of the transaction. And that's basically excluding a lot of institutions.
Okay, so that's nice and clear. And as we can see, the problems arise twofold, as you say, which is that the people who create these deals take too much money for themselves and put it in their own pockets. So something comes in one door and goes out the other, but what goes out the other door is rather less than came in the first door. So if you bought it all for the sake of argument, you'd clearly be getting a worse deal than if you bought it unsecuritized in the first place. And then the second point, of course, as we all know, CDO squares and all this kind of stuff, which is that all the rocket scientists or quantum physicists or whatever in investment banks in Wall Street in particular with the mortgage crisis are too clever, if not for their own good, because they managed to fill their own boots, but actually too clever for the investors' good, and they bamboozle the rating agencies as well. And in principle, it's caveat emptor, and risk departments in insurance companies and investors look at this stuff, but it doesn't always work out. So then we come on to your vehicle in terms of securitization in the digital age, fintech securitization, and I think along with the listeners, I'm fascinated by how you reform an industry. The process must remain the same. We take a bunch of stuff, we stick it in a special purpose vehicle, in a company, we offer, for the sake of argument, shares. I mean, let's not get into legal stuff here, in that to people. And to do that today, if you go to one of the banks, will cost millions, and you need hundreds of millions of loans in the first place. So how on earth did you find a way of doing it almost infinitely cheaper and an infinitely smaller size? Was it something to do with quantum, which is very small things on there?
That has nothing to do with quantum mechanics, but yes, maybe miniaturizing stuff. That's what we do. Yeah, no, I mean, the trick that we're using here is we standardize stuff. We have a completely standardized workflow which can be fully automated, so all the documents that need to be created for such a transaction are created in an automated fashion. Of course, we need to set up certain deal structures once, but once we have done that, we can then replicate them at very low costs. I mean, this is basically what is missing in the financial ecosystem at the moment, standardization. You have that in the full value chain of lending. It starts with the scoring. Different scores, different scoring bureaus don't mean the same thing. The banks do a completely different risk analysis. So there's a lack of standardization, but as soon as you bring that level of standardization into the process, you can fully automate it, and then it basically doesn't cost anything.
And so going back to the size that you can securitize, as you said earlier, single loans, but I didn't mention the size and the costs. So what's the smallest single loan that you could securitize, and how much would that cost?
So the smallest loan that we actually did was 1,500 euros.
Wow, I can lend you that much. You can securitize my loan.
We can securitize that, yes, of course. So no, that was the smallest loan. Does it make sense to do that always for such small loans? That depends on the use case, but in principle what that means is that we've designed a very, very efficient way of securitizing stuff, and that means that we can of course also do a securitization for the daily origination or for the weekly origination or monthly origination of a bank or whatever. So what that allows us to do is basically be very flexible the way we offload stuff from banks' balance sheets.
Or in this case, fintech's balance sheets, because I can think of plenty of fintechs that in London and I'm sure in Europe that should be getting in touch with you guys and finding out how it works and how they might use that themselves. I mean, we've seen the likes of Funding Circle do sort of traditional large securitizations, but I'm sure they paid rather more money than they would you. So what are the fees roughly for doing, I don't know, 1,500 euros or 150 million euros?
We have a very low two-digit amount in euro that we have to charge for securitization, but of course if it's larger transactions then that changes because there's some setup that goes with it, but the actual costs for the act of securitizing something is very low, it's negligible.
negligible. It was very impressive. Okay, so in terms of the single loan securitization, we've done it all very simplistically, although schematically correct, I think. In practice, there's always quite a lot of details in this, so I believe that one of your colleagues has been, I don't know, it's exiled or promoted to live in Luxembourg.
No, that was a promotion.
That's what you said to him as a chief executive. Have I got news for you?
No, I mean, Luxembourg is the natural place for that type of securitization. In Luxembourg, there's roughly 1,000 securitization vehicles, or we are one of the 30 actually licensed vehicles, so we are supervised by the regulator, which is also important as a startup, I think, that you're not trying to fly under the radar. But also for counterparties, you can show that you're actually doing something that is highly approved by the regulator. Maybe about the company a bit. So CrossLend is now grown to a team of 45 people. Some of us now are in Luxembourg. We have an office in Luxembourg. We have our headquarters in Berlin. And have done a lot of interesting stuff since then. Quite a significant pipeline volume sitting between banks and insurance companies. We're talking about something like 1.5 to 2 billion at the moment in the pipeline.
Once we're talking about 1.5 billion in the pipeline, it doesn't really matter whether it's dollars, sterling or euros. That starts to be a big number.
It is euros, but so how does that come? I mean, what we are offering is something that at the moment is only accessible for large institutions. And look, you have thousands of banks, of smaller banks in Europe that have typical overcapacities between 50 and 200 million a year. So that's a typical range. That's banks that originate maybe 700-800 million a year, and they could do an extra 50, but they can't due to equity limit. So what we're helping them is effectively we are providing a marketplace where they can offer this excess exposure. And we're offering that to investors who are desperately looking for fixed income yield. So what that means is that we are unlocking exposure or we're unlocking origination in the market. So we're not competing with anybody at the moment. So we're really unlocking new origination in the market and help these organizations to become more profitable.
So obviously you need two things. You need a conduit or channels to the originators,
yes,
to the banks, as it were. If we fast forward 10 years, you'd like a sort of salesman sitting on every bank doorstep around Europe, saying that they're there to help. And then on the other side, of course, because so far we've focused on how the structuring has worked with securities, but of course the other thing that the investment banks do is they don't just structure them, they actually have salesmen who go and sell all these things.
Yeah.
So on the other side, you will need in 10 years' time a salesman sitting on the side of every investor of significance in Europe. So that sort of Gedanken involves quite a lot of salesmen because there's quite a lot of banks and quite a lot of investors. So in practice, in terms of where you are today, how are you reaching originators? Are you working sort of just in Germany and the UK, or which countries are you in terms of investors? I mean, have you got too many originators or too few investors? Or I mean, there's always an imbalance. It's a bit like peer-to-peer. You've always got too much on this side or that side.
Well, we're in the fortunate position that we work across Europe. So we are in Germany, Netherlands, Spain. We have in UK, we're in Portugal, we are in Norway, we're in Finland. So there's quite a bunch of countries, and of course our salespeople know whether we need more investors or more originators. So at the moment we have in the pipeline 1.5 billion of originators that want looking for investment and 2 billion of investors that want to invest. So that's quite balanced at the moment. But getting to your point, of course, the answer to that is we'd like to transform that into an exchange type of framework. So since we can securitize risk down to a very granular level, it makes a lot of sense to also provide a secondary market for that. And since we're using securities, this is a straightforward thing to do. One of our investors being CME Ventures, so the venture arm of the CME Group in Chicago. And basically, if you manage to transform that into an exchange, then yes, of course you need to do sales, but then you are the place where that is traded. And what you need for that is infrastructure. This is what we're building at the moment based on securitization. And you need risk normalization, because what's really important for such a marketplace is that all the investors understand what the risks on the market, how to assess the risk on the marketplace. And also risk is moving over time. So something that has a very high risk in the beginning can over time reduce its risk due to maturity. Okay,
so plans for the future are to go beyond where you started in terms of being able to securitize a loan or a package of loans far, 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 far cheaper than it was done in the past, to extending, as you say, that model to actually creating a marketplace.
Exactly.
Where these things can be traded.
Exactly. So what we're trying to achieve here is to combine the lessons learned from our peer-to-peer history with the advantages that we see in the traditional origination of banks, So you can also think of it as we are making banks peer-to-peer capable. So we're providing a meta marketplace which can be an additional refinancing source for banks, one that is not available today. And at the same time, we're offering a new asset class to investors, trying to combine the versatility of peer-to-peer lending, but still keeping the origination within the bank, which has the experience, which has the data, and which also has the customer relationship.
Okay, well, I think that sounds like one for a future show when you've got that up and running, because I think the interesting thing that starts to come in there is, this is always, of course, how markets are measured, which is the one of liquidity.
Yeah.
Because one of the challenges of the plain peer-to-peer model, as we all know, but I'm never quite sure anyone can actually put a value to it, which is the potential illiquidity. You might give your money to a large peer-to-peer platform that's perfectly reputable for the sake of argument for 3 years or 5 years, but in 2 years' time you may, for some reason, need to get your money back. Now, certainly in the UK, all the platforms say that they will try their best if you turn up and say, oh, can I have my money back, please, before the time to do something in terms of selling it to new investors and all that. But again, having been around the city for a while, the tide comes in and the tide goes out. And when the tide goes out, oh, look, that's a useful metaphor because it's got liquid in it. When the tide goes out, there's rather less liquidity, ha-ha. And it can prove very difficult to get your money out. Whereas if things are securitized on an exchange, then depending on how liquid it is, you will always be able to sell, even if the price isn't as attractive as it was the week before the crisis happened.
Exactly, and liquidity on a debt exchange is seen to be different than from any other exchange type, because you have a natural exit way all the time, because there's traditional securitization with tranched ABS instruments. So this is your natural exit way all the time. There's a market for that existing today, so that also allows you to do market making on such an exchange. And the key here is, it's again about risk normalization.
And when you say risk normalization, you mean?
I mean that there's risk class A, B, C, and everybody understands what that means.
Right.
So whether it's a UK platform loan or it's a Spanish SME loan, so what's happening over time is that the defaults of consumer loans, for example, hit you in the beginning. Everybody knows that. Then over time, the default curve is going down. That means that a Spanish retail customer, after 20 months, can have the same risk profile than a German civil servant on day one, for example. So both could be at that time risk class A. If the market understands what that means, and the market does understand what that means because the market today is relying on rating agencies to assess the risk, so the market is already used to listening to third-party risk assessment. If we manage to combine that, then we can have liquidity.
Exactly. And just thinking about it, back in the day when AAA meant AAA, when I was a lad, AAA was AAA. What it means, as you say, about liquidity, of course, liquidity and pricing are completely connected, which is that, let's say you're trying to sell your security, it can't be that out of line, because you're saying back to market makers.
Sure.
If it's too cheap, then a market maker will buy it because it is AAA.
Absolutely, yes, and the market maker will buy it if it's slightly below fair price because he has a natural exit channel to ABS.
Exactly, so it's arbitraging. Excellent, well that's nice and simple and nice and clear, and I hope all the people who are out there listening to this who have lack of balance sheet capacity or who would just like to check out as a strategic option the idea of moving on some of their loans, will give you guys a call. I'd like to thank my brand partners for the podcast, Blue Motor Finance, who combine extensive experience with a fresh and innovative approach. Blue's award-winning technology has supported over £500 million of lending to over 50,000 customers. Smart Pension, who are fast, secure and free. Check out their UK workplace pensions at autoenrollment.co.uk. So we've spoken a little bit there about CrossLend and where you're going and all that kind of stuff. And in terms of originators, investors, partners, workers out there in the audience, what sort of 2 or 3 things are you after in particular at the moment, Oliver?
Of course, we are looking for talent, like everybody else. So if you're very smart and you have a background in capital markets or risk, sales or legal role, then please reach out. We're always also looking for strategic investors who have special angle, have invested into banks, insurance companies, or extensively in Fintech. That always adds value to our company. And then, of course, if you have a bank with a balance sheet and you would like to securitize off something, or you have a balance sheet to invest from, we have a €2 billion investor capital sitting waiting for your offloaded loans, and we have a 1.5 billion pipeline on the origination side maybe there's something you want to invest into.
Excellent. Well, that's very clear. And I should have said up front that I'm grateful to my friend John Goodall of Landbay, who introduced me to Alex at Lendit, where you guys had a stall, and just came back to the talent point and how the old world of FS is coming together with the new world. Alex's background, I understand, was at JP Morgan.
Exactly.
So there is this convergence. There is less and less of a difference between old FS and new FS. It's just becoming how financial services is changing digitally, and you're getting smart people on both sides of the equation. And where we're sitting today in a private members business club in Berkeley Square, which I was on the board of some time ago, we in this business here did pretty well in the late 90s and early noughties from folks who were leaving big incumbents at the time to set up hedge funds.
Yeah.
And there was a lot of talent moving from the sort of boring, slow investment sides or trading sides that they saw into doing their own thing. And I think that in a way, plus ça change, plus c'est la même chose, which is that things change, but actually it's the same principle, which is that I'm sure Alex was having a lovely time at JP Morgan, for example, but I'm sure it's even more exciting working for a firm like yours, which has really got some interesting ideas and actually has got the means and ability, like many fintechs, to implement them fairly rapidly. So I wish you every success on your journey, and I hope that some of the listeners will get in touch.
Thank you so much, Mike.
Thanks for listening. If you have consulting, advisory/non-exec or media needs in the FS or fintech space, get in touch with me at mike@londonfintechpodcast.com.
We could sit in a bend there all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moonrise, watching a happy moonrise. Come away from the city, with the tarmac so dead and the people so sad. Come away from the city, with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fit in between the earth and the sky. Kiss the city goodbye, wave the city goodbye, wave the city goodbye. The city goodbye. Watch the firelight dance with me. 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 Watch the firelight